Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Oracle Corporation, ticker ORCL. They have been on the watch list for a while and have their earnings next week. So I want to get ahead of it, take a look at them before earnings, just in case it's worth buying at today's prices, or at least to see what kind of numbers we expect from earnings. Now, I feel like this is going to be a pretty quick video because there are some things I like and some things I don't like with this one. It's got growth, but fundamentally, there are some red flags. Not a huge issue. If you're a growth investor, it might be worth taking the risk. If you're a value investor, there are definitely other opportunities that I would take over this. So what we're looking at here is a current value of about $233. The 52-week high of $261 and 52-week low of $119. Fair value coming up with about 179.5, which means with a margin of safety, if there are some red flags here, we'd want to see it more towards 125, 130 to get in. And it'd be overvalued if it were 200 or more, which it's currently at. On an earnings front, it's pretty overvalued. With an earnings yield of 3.17 for what we're paying, we would want somewhere in the realm of $11.64 in EPS. And what you're actually getting from them is expectations for this year, 678, next year, 814. So that is a few years out for that EPS. Cash flow yield, they're obviously investing heavy. If you take a look at the cash flow chart, they had some great growing cash flows, and then it dipped way down. It's not a massive red flag. Once they stop with the investment, their cash flows will likely jump back up. But for now, we will have to see how long they're going to continue with these investments and if they pay off. Dividend yield is pretty low at 0.76, on average 1.44. So that shows that the price is quite a bit higher than the market usually values this stock. I'd say that's obvious from both the earnings and the dividend. And the cash flows might be part of that tale, where investors are expecting some massive growth here in the future because of all the investment that they're doing. ROE looks amazing, 60.5, too good to be true, and it is. With a debt to equity of 7.17, they have more debt than I'm comfortable with a company in my portfolio having. ROI is okay, 6.8, and ROA is okay at 7.4. We've seen better, but we've seen worse. Gross margins are great, exactly where we like to see. 70.56 on average, 73.48, so high and growing. And the net, right where we like it, 21.6. For a company like this, perfect. Most companies, 30 and 10, as I usually say, but 60 and 20 for tech growth companies with a bigger moat and less competition. PE ratio is currently 34, with an earnings growth rate of 20, puts them at a PEG of 1.7. So again, elevated, but we already know it's a little pricey, right? Then we come down to the thesis. So over the last 3 years, revenues have grown 10.5%. Over the last two, about 7%, but analysts are expecting a big jump, 16 to 18% over the next 2 years. So 16.5, 17, somewhere in there seems to be reasonable according to analysts. And that's part of the investments that they're doing are going to drive those revenues higher. Share count, they grow their share count. Again, that's kind of a red flag. It's not the worst. With all the debt that they have, I'm not surprised. That's part of why I don't like heavy debt companies. Issue shares, take that money and pay off their debt. That's the intelligent thing to do, but that's diluting you as a shareholder. So you're already losing out almost 2% a year just because they're issuing shares. Asset growth, it's high, slowing down. If you look, it dropped 3 to 4% in the last few years. So another drop of 3 to 4% would take them down to 8. And liabilities, same story here. It dropped 3%. If it drops 2 to 3%, we'd be looking at about 3. Dividend, I'd like to see them continue growing double digit. They've got plenty of wiggle room with their earnings. They're currently at a dividend payout ratio of 23. We like to see that closer to 50, but they obviously care more about operations and growth than they do about shareholders. I'm not saying that they don't care about their shareholders, but if you're issuing shares, you're not trying to return to shareholders in the conventional methods. You're trying to get this growth rate up to return more over time. And that's obviously what they're doing. So I wouldn't be surprised if they slowed down on this dividend and focused more on that growth. And then margin growth, something small, 1% growth takes them to almost 23% net margins over the course of the next 5 years, which would be great to see. So all of that combined gives you an annual growth rate of almost 14%. And I will say cash flows are dragging this down. They had negative cash flows. There's not an easy way to mathematically reflect that without tweaking my formulas. So this growth is making things look worse. So I'd say 14% growth on the low end. Once you factor in the dividend, you're looking at about 14.5%, almost 15%. Which means that you're outperforming the market by nearly 50%. You talk 8 to 10% for the S&P annually. Well, you're looking at 14 to 15 here. But starting out at a high price, current price, in 3 years with that growth, you're still only talking about a fair value of about $207, and in 5 years, $270. So you're underwater in the 3 years. But if the thesis holds up in the next 5 years, you're still underperforming the market because you bought in at a high price. But if the multiple that it's currently trading at holds, we're talking 4-year out values, next year you could be in decent shape. I do want to tweak things a little bit, see if we can get a bit more of a bullish case because they are investing heavy. So if we get our revenues, 17 to 17.5 would be more towards the higher end of what analysts are expecting. That gave us a nice little boost. If they can slow down on the share issuance, because there are more shares. So if you're issuing that much, that's a bit of a problem. Cash flow growth, I mean, if we keep this flat, I think it'll help. Yeah, it helps to just keep it flat. So we're assuming they're continuing investment for the next 3 to 5 years. Maybe a bit more asset growth as part of that, slightly less liability. Remember, we're trying to get a more bullish case. I feel like that's as reasonable as I can be. And that brings you to, again, probably on the lower end, somewhere in the realm of 15%, which once you factor in the dividend, 15.5. For a growth investor, I can see a place for this in your portfolio. As a value investor, I'd approach with caution. I'd want at least a lower entry price. Now, if I could get in at this high price, I'm not even sure 200 would be the price for me because you're still in 5 years underwater. Maybe 190. Let's see, the 180 to 190 range. I could stomach that. 175. I'd want a bit more of a discount for the risk I'm taking on. Yeah, for me personally, I'd be looking for 160 on this. Am I going to get it? No idea. It has been as low as 119 though, so it'll be on the watch list. I might, if it hits 200, buy a little bit, and then I'll go heavier and dollar cost average if it continues to dip. But we'll have to see. We'll see how these earnings go and if they live up to everyone's expectations. But I want to thank you guys for watching. Please like, enjoy the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. I'll catch you next time.